presented by Morningstar Indexes.
Welcome to ETF TV, your insight into the world of exchange-traded funds, issuers, and investments. I'm Margareta Hricova, and joining me today is Sanjay Arya, Head of Innovation at Morningstar, and Deborah Fuhr. Welcome to the show.
Glad to be here.
Thank you. Sanjay, great to see you. There's a lot of interest in private markets. Why is that, and what does that cover?
Private markets in general covers 4 different areas. Private equity, which also includes venture, private debt, infrastructure, and real estate. And we've seen an explosive growth, I guess, in the last 2 decades in this market. There are a number of factors behind that. Regulation or regulatory change has been one of the primary factors. In the US, we've seen regulations like Sarbanes-Oxley in 2002, Dodd-Frank in 2012 after the global financial crisis, and all of that actually increases the burden to be a publicly listed company. So a lot of private companies, they're shying away from going public. And then on the private side, we've seen, the Jobs Act of 2012 increased participation in private companies, increasing the number of investors from 500 to 2,000. That's been very favorable for this market. Same thing on the debt markets as well. I think banks are more risk averse. Alternative issuers, like asset managers have gotten in the space. I think the low interest rate cycle that we've gone through, I think that enabled a lot of private equity firms to borrow cheaply and kind of use that to invest in these asset classes. And there's been a lot of non-traditional investors who actually entered the space from corporate VCs, hedge funds, mutual funds. I think they bring a lot more capital, which has actually enabled and supported the growth of this market as well. And lastly, I think overall the asset class has done well. Anytime you have strong performance, it attracts more investors as well.
And how do you create indices and value private equity?
Yeah, good question. So, there are a lot of structural and operational complexities in building indexes for private asset classes. At the outset, we identified there were 3 primary friction points or, challenges that we had. The first thing is data is not easily accessible. These companies, since they're private, there's no disclosure requirements. And even when we access the data, it's not very structured. Even there's simple things like security identifiers, industry taxonomies. None of that is available for this segment of the market. For us, I think we were very fortunate to have access to the best private company data through PitchBook. They are a sister company of Morningstar. We acquired them 7 years ago. Having access to all of that data has been helpful, and we've been working with them for a few years now. The second thing is, pricing or valuation of the securities that go into making these indexes. So anytime you create a basket of securities, be it portfolio or index, you need to make sure the market agrees upon what the value of that asset is. So it's not something subjective. So we've done a lot of, research here. We've talked to a lot of folks in the industry using secondary markets as the source of data. I think we've been able to figure out the best way to solve for this problem. And then lastly, I think governance has been an important issue in our industry, coming out of the crisis. I think making sure that we meet high standards of benchmark regulation. There are robust processes, avoidance of any conflict of interest internally. So those are kind of the 3 main things I guess we've worked on, and, having experience in building indexes for the last 25 years, we think we've been able to kind of meet all of those requirements.
How can investors invest in private equity?
A lot of skeptics would say that this is an asset class, which is hard to invest in. And we would agree with that today. It's probably not quite there yet. And I think we kind of go back and look at, how some of the other markets have evolved over time. Fixed income being kind of a great example. 50 years ago, you probably had to trade bonds by appointment, call up your broker-dealer and kind of do the transaction. Even 20 years ago, when the first bond ETFs were launched, I think a lot of people thought these are not going to survive. But today, as we know, I think that's actually one of the most liquid places where the price discovery in this market happens. Likewise, we think the arc of innovation will help evolve this space. And we're beginning to see a lot of that happening in the secondary markets. So, these are growing. It's about $150 billion in secondary market, late stage venture-backed companies that are trading. So if you want to trade SpaceX or Stripe or OpenAI, there are a lot of platforms where you can do that. And over time, we think these secondary markets will be a good access point for anybody who wants to replicate these strategies.
That's great. Thank you for joining us.
Thanks for having me.
Thank you to Morningstar for sponsoring this episode, and to all of you for watching. To watch prior episodes and to see news from the ETF industry, visit us at etftv.net. Thank you.
ETF TV News does not provide investment advice nor recommend products.